Hi friends, today we're going to understand how to measure a financial performance of a company in any industry. And based on this particular measure, based on this specific metrics, which I'm going to share in this specific video, we are going to use this metric to determine our great companies where we can park our money into, our great companies which we can multiply our money based on the amount of multiplication we actually desire. And this ratio is none other than return on equity. As a matter of fact, a lot of us are aware about how to measure individual performance in a specific industry. I, coming from the IT background, we measure the tester's performance based on how many test cases have been executed in a specific hour, or how many defects have been identified per 100 test cases being executed. Or when it comes to development or coding, depending on how many lines of code he has written and how many defects or issues could be found in those specific lines of code, the developer's performance is measured. This in IT industry, every person is actually aware of. Now when it comes to financial performance, there are n number of matrices, but this ratio which I'm going to discuss, which is the return on equity, is one of the key measures which every investor, value or growth investor, uses to determine the company of a choice, wherein he can multiply the money based on the aspect or based on the multiplication factor he desires, be it 5 times, 6 times, 10 times over a period of 10 years. It all depends on the company and the ROE factor. So in this specific video, we're going to understand what is ROE, how it is calculated, is there any benchmark. The second aspect, we are going to study what is the benchmark of ROE which we can use to filter out those companies. As a matter of fact, please remember, ROE is one of the major factors, but however, there are other factors as well which need to be used in conjunction with ROE. So this video is meant for this educational purpose only with respect to ROE, return on equity, which is one of the major aspects. The third aspect we are going to study in this video is about what kind of investors typically use ROE to take their own investing decisions. And fourth, we are going to see my own learnings, my own experience out of those 12 years, what I have learned for myself upon using ROE to take my own investing decision. So the first aspect is what is ROE? Return on equity. It's simple, isn't it? Return on equity. And when you talk about the return is the profit earned by the company. And where do you find this profit? This profit you will find in the income statement or the profit and loss statement of the company, which you will find in your annual report. And when you talk about the equity of the company, this you will find it in the balance sheet of the company as part of the shareholders' equity. In the balance sheet, in the annual report, you will find it as part of another section called balance sheet. You will find shareholders' equity. And how do we get the ratio? We just take the profit from the profit and loss, and then we take the shareholders' equity from the balance sheet. We divide these two to give us the return on equity ratio. For example, if you have a profit of 20 rupees earned over a shareholders' equity of 100 rupees, that would give me a return on equity of 20%. 20% year on year. And if it is 25% year on year, that means the shareholders' equity is actually becoming bigger 10 times in a period of 10 years. 10 times in a period of 10 years. You can do the maths for yourself and check it out. So ROE is hence very crucial indicator to determine what is the multiplication factor of wealth you desire from the investment you put in a specific company. Well, there are various other aspects, valuation and other aspects and other ratios which go in conjunction. I'm not coming to that. Let us focus just on ROE. Now that you have known what is ROE and how it is actually calculated based on this formula, let us see the second aspect is about understanding what is the benchmark. How do we arrive to a benchmark of determining, which is a good benchmark of ROE which we can use to determine the company which we want to park our money into or invest our money into. As a general rule, more than 15% is a great company to invest our capital into a specific company. ROE of more than 15 or more than 16%. So that's a great company. But however, if you want a multiplication factor of 10 times over a period of 10 years, then obviously you have to go for an ROE of 25%, isn't it? So depending on how many multi-baggers you desire from a specific company, you need to select that specific ROE. So when I take my own investing call, so I have a lot of filters. ROE is one of them. And when I see ROE, I typically go for something which is greater than 16%, and then I filter out in the order. And based on the topmost ROE, I decide based on various other factors like qualitative as well as quantifiable measures apart from ROE, which will help me decide whether to park my money or invest my money into that specific company. So let us take back on the topic on ROE. As I have already covered about the benchmark, what benchmark we could use, 15% and above is advisable. Well, when you see companies which have an ROE of more than 100%, or about 80% or 90%, that is where my experience will come helpful to you, which is going to be covered in the fourth topic in this specific video. So let us see, before we discuss the fourth topic, let us see the third aspect, what typical investors, what are kind of investors who use ROE to make their investing decision. Well, these investors could be value investors or growth investors. So when these investors use ROE to make the investing decision, they are typically looking for companies which earn profit, and upon earning this profit, like go with an example, I have a business and I have this invested capital, the shareholders equity, called as the invested capital of 100 rupees, with which I have purchased a particular shop. I put certain furniture and set it up, maybe with a coffee machine, selling coffee to the customers. And now upon running these operations daily, on a daily basis, or a yearly basis, when I go and measure the profit, and I see the profit is 20 rupees by the end of the year, my invested amount is 100 rupees. So I have an ROE of 20%, isn't it? So now this 20 rupees ROE, which is measured, a good company, when I say good company, I say a company which would multiply investors' fortunes multiple times, would think about reinvesting this profit back into the business. So this 20 rupees earned is invested back into the business without paying any dividends to the shareholders, as it knows that by reinvesting 20 rupees back, it could go on an acquisition spree. It could multiply or grow the shareholders' wealth even more further. By investing 120 rupees, it could grow the profit by say another 40 or 50 rupees. Isn't that a great investment or great company? Wouldn't you be willing to put back the profit into the retained earnings? These are the type of investors who are growth oriented. They are looking to grow the capital multi-bagger time, 10 times in 10 years, or maybe 100 times in 10 years is possible. There are companies which fulfill that as well. But you need to be very careful by going for ROE to make your investing decision. That is where the fourth lesson, which I have learned, the fourth aspect, this is the lesson which I have learned to make my own investing decision based on ROE. Well, you could find companies which have ROE of like 100% as well, but then you need to be careful that it might not be retaining all its earning, but is giving off all its earning as dividend, and then the profit earned subsequent years is like turning out to be popped up ROE, which you need to be very careful. One of the major lessons which I have learned is you need to see consistent ROE over a period of years. The first aspect of my learning is like over a period of 10 years, at least 10 years, not 5 years, 10 years to the minimum, you need to see ROE of more than, for me it is more than 16%, 20% best, because you want a multi-bagger, isn't it? Better the ROE, great company. That is one of the aspects, consistent ROE over a period of 10 years, unwaveringly about 20%. 20, 22, 25, falling down to 21, cool. More than 20% consistently is what I am looking at. That's the first aspect. The second aspect which I am looking at is not only 20% ROE, but retained earnings year on year should also be significantly good enough. 50% is great, but 100% is fantastic. It's reinvesting 100% and earning 20% every year on year. This is much more better company than a company which actually invests only 20% and earning 20% ROE. Is the lesson which I have learned, and over a period of time, the market will definitely reward investors who go for companies which are undervalued and having a good ROE, consistent ROE over a period of time. Along with ROE, you have strong, stable balance sheets which you need to look into. You need to look into strong cash flows. all these aspects you need to look over a period of time, over a duration of time, and of course the future of the particular product in the long period of time, long course of time, so that unwaveringly it should multiply your wealth significantly now. So that was all in this specific video which I wanted to share about ROE, return on equity, and I hope you liked it. If you have any comments, queries, drop it in the comment box and I'll be glad to respond to your comments on the YouTube itself. So see you until then, my next subsequent video which I share every alternate days. Bye.